Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. For any of you that follow the markets, you probably already know that volatility continues. Today, I'm chatting with Evan Rudy, head of investment strategy from DWS, about what he sees coming down the pike for the markets. And here's the biggest question I think I'm going to ask him today is if we've reached the peak for inflation. So, Evan, it's really nice to have you join us on the show. Thanks for being here.
Thanks, Anthony, for having me this morning.
Great.
My pleasure.
And look, Evan, I know you've been a busy person, as we all have, just kind of watching what's going on with the markets. There's been so much volatility thanks to so much news flow and uncertainty. But let's talk about that volatility. What do you think right now are the biggest drivers? And here's the question. Do you think that this kind of volatility will continue through the summer? Because it seems like there's no end to what we've been experiencing for the last couple of months now.
Yes, you're absolutely right. I think, realized volatility on a rolling 30-day basis is as high now as it's been at any point over the last 10 years outside of the drawdowns during COVID. So the amount of uncertainty in the markets right now is, near, decade highs. Obviously the news flow isn't very constructive across the board. Obviously you had, kicking off with the Russia-Ukraine conflict, lockdowns across Asia and China with COVID, this surging inflation across the board. I think, there's worries for investors, that are abound. And I don't know if that's going to, calm down much in the near future. Obviously, we have, we're talking on Wednesday, the 25th. We have the Fed minutes coming out later today. Obviously, the worry is that the Fed is really in between a rock and a hard space, with inflation as high as it is, but also the equity markets are already down, 17 to 18% as we stand today. So, from our standpoint, I think we have a pretty choppy market from here. I think the Fed has to continue to push forward on those rate hikes and that uncertainty of the path of inflation, the path for energy and food prices. Will continue to kind of have that volatility creep up in the markets.
Yeah, and just looking at statistically, if you look at the equity market, specifically the S&P 500, it's one of the worst starts to a year we've seen in a couple of decades. So, and having to do a lot with what you just talked about here. And certainly the Fed does have a pretty big job ahead of them. But before we get to them, I wanted to ask you about this inflation that we're experiencing, 8.5% at the last reading last month. Have we seen the peak yet, or are we getting close to that? And, following that, the question always comes, and I'm sure you're getting it as well, is about the recession and if we're maybe headed into one before the year is over or maybe even early 23. What are your thoughts there, Evan?
Yeah, on the inflation, obviously, that's the we call it the billion-dollar question, if you will. You said, 8.3% inflation on a headline basis year over year. The monthly print for March or for April was, a little softer, 0.3% month over month after a 1.2 print in March. I will tell you, it's looking like the May print might be a little higher. Current estimates are about 0.7, which will keep inflation somewhere around 8.2% on a year-over-year basis. So continue to keep it very elevated. Have we seen peak inflation? I mean, the markets are telling you we have. You've seen kind of 2-year and 5-year break-evens come off from their late March highs pretty significantly. But on a headline basis, I think we kind of stay around this 7.5% to 8% inflation for some time. One thing that I like to look at is what we call super core inflation. We have our core inflation, but we also can exclude a few more things. So super core inflation is, all items less food, energy, shelter, and used cars and trucks, and makes up about 40% of the overall CPI index, and that is now kind of accelerating at its fastest pace yet. At about 6% year over year through April, and so that has continued to get stronger and stronger. Obviously, we know that energy prices are moving high. Natural gas is pushing to $9 per MMBTU today as we speak. So we think the energy component will continue to move higher. And then on the food side, food prices tend to kind of creep into inflation on a 6 to 7 month lag. Grains prices have come off a little bit, but they're still elevated, especially relative to the last 10 years. And so we think the food inflation will continue to push through, and in those official CPI numbers through the end of the year. So all that kind of keeps inflation elevated. Now we're looking for some kind of deflationary trends and maybe some goods within the CPI index. Over the last 20 years, out of 265 different components in inflation, on average, about 33% of those are deflating on a 3-month basis at any given point in time. We're sitting at about 10 to 12% right now, which is 20-year low. So we haven't seen that kind of the deflation in some of those goods really start to creep in yet, and that's something that we'll be watching for, over the next couple of months as these inflation prints, most likely stay pretty sticky.
Yeah, you can ask any consumer out there who's been filling their car up with gas. They know the feeling of inflation continuing to rise. So thanks for that, Evan. You mentioned the Fed. We've got, as you said, we're filming this on Wednesday, the 25th of May. The Fed has the minutes of the last meeting coming out at 2 o'clock today before we're actually filming this, or I should say after we're filming this. And the next Fed meeting is on June 14th and 15th, where it is expected that they're going to go another 50 basis points. But we know that the Fed has an inflation mandate. But do you think that they're tightening too much? Clearly, they have to see what's happening in the markets. That's clearly not what they have to really focus on. They have to focus on monetary policy, but they can't ignore the volatility on the market side. Are they tightening too much here?
I would say no. We have nominal growth that is still extremely strong. Nominal growth was over 10% on a year-over-year basis through the first quarter. If you're going to isolate first quarter in itself, you've got a 6.5% annualized nominal growth rate, which is, better than all but 3 quarters over the past decade before before COVID. So call it 2010s. We only had 3 quarters of nominal growth that were stronger than the first quarter. So nominal growth is extremely strong, right? They have 2 mandates. They have an inflation mandate and they have an employment mandate, right? Unemployment, whether it's U3, U6, are kind of multi-decade lows. So they have the full employment, but they have to solve this inflation problem. And I think for the first time in quite a while, they're not nearly as concerned about S&P isn't their kind of gauge for if they're doing their job. I really think they're going to keep tightening until they start to see this inflation move down. If you think about it, what's really come in. It's been a lot of the high growth stuff, the high growth, higher multiple names within the index, and have become a large portion of the equity index over the last 10 years. As we've had very easy policy. So, although, equity markets have come off a bit, there are places with kind of, good fundamentals and strong free cash flows that have continued to hold up on a relative basis pretty well. So, short answer is no, I don't think they're tightening too much. I think, strong nominal growth will continue to push inflation, keep inflation high if they don't keep hiking and try to tighten a little bit more.
Right. Yeah. Certainly, Jay Powell and the Fed have a big job ahead of them for the rest of this year and into next year for sure. Let me ask you: are you surprised about, and switching gears a little bit, are you surprised that we've seen such a big run up in commodities and even natural resource equities when most other asset classes that we see are actually down? And do you think that this kind of trend of commodity outperformance will continue?
It's not surprising, given kind of the backdrop of what's happening around the world. For a number of years, those kind of we have a commodity team that does great work, and I would say it's probably echoed across a lot of commodity shops. The supply-demand kind of imbalance has been there. Lack of investment over the last decade in mining and energy. Has really put us in a situation where supply has been fairly low. And then kind of maybe this Russia-Ukraine war is really just the accelerant to something that has been a problem for a number of years. And so, we've seen commodities are up 33% if you look at the kind of the BCOM index, but it's really pretty concentrated in energy and in grains. Energy is up 85%, with natural gas up 150%, grains are up about 35%. Outside of those 2 sectors, there hasn't been a whole lot of price appreciation more recently. Something like industrial metals, which are in that same type of dynamic where kind of the micro, if you will, is very tight because of the lockdowns in China. We've seen some weakness there as well. So, not surprised at the strength in commodity markets, and I think we can see that can continue even more. Unfortunately, it seems like we might have a global food shortage coming up soon. There's been a lot more protectionism More recently, Indonesia just banned all vegetable oil exports. India's banning wheat and sugar exports. China just extended the ban on fertilizer exports until mid-2023. So, and the weather situation in the U.S. For planting crops has not been ideal. So I think a lot of the strength in the commodity prices, can persist. Not necessarily going to be as strong as they have been, but we don't see a whole lot of downside to some of these commodity prices. Now, that being said, you might see Europe, having very weak growth. China obviously is going to have pretty weak growth, and they're going to have to continue to stimulate their economy there. So that could, put a bit of a drag and a bit of, headwinds in terms of the commodity complex. But all in all, kind of the supply and demand dynamics there are extremely tight. And then those natural resource equity companies, like you mentioned, have continued to do well. They obviously benefit from rising commodity prices, but they've also taken the last 10 years to kind of repair balance sheets and return cash to shareholders. I think the cash flow yields are something like 8.5%.
Yeah, it seems to all go back to economics 101, doesn't it, Evan? Supply and demand. I mean, sometimes it's as simple as that. Thank you for that. And we've only got about a minute left, but I wanted to get your sense before we wrap up today for our audience, where you see opportunities today for investors, specifically when it comes to real assets in terms of portfolio construction.
Yeah, sure. And so, we talked about commodities and natural resources. We also focus on listed real estate and global infrastructure. And a lot of these asset classes are kind of in no man's land, if you will. A lot of them are listed equities, but they act a little bit different. They have income components like fixed income, yielding 3.5% to 4%. And so they fit somewhere in between kind of your equity and fixed income, it's a kind of alternatives bucket. And for a long time we've been telling clients, with yields on fixed income as low as they were, and with multiples on some of the kind of broader equity markets as high as they were, real assets have been underperforming for the last decade. And we've started to see a reversal in some of that trend. So whether it's, replacing some income out of your fixed income bucket or trying to balance out some of your equity exposure into, better relative values in terms of multiples and valuation, we think real assets fit somewhere in between there. So it obviously depends, on each client, but, I think you could take it from either bucket and have that diversification really be beneficial to a portfolio over the next short to intermediate time frame.
Great. Evan, thanks very much. Appreciate the breakdown and all your inside information today. Actually, I should not use the word inside information. your font of information. That's probably more compliant here. But Evan, thank you very much. Good to see you.
Thanks, Anthony, for having me. Appreciate it.
Terrific. There again, we've been speaking with Evan Rudy, Head of Investment Strategy at DWS. Thanks, Evan. And for more information and content from UBS, you can visit our website at ubs.com/views and follow us on social media, all the channels, LinkedIn, Facebook, Instagram, and Twitter. Plus, check out all of our past UBS Trending episodes on demand. And as always, if you have any questions about your own portfolio based on our conversation today, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.